Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing BigBear.ai stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 2.2 billion market cap. They're trading at $8.59 a share, and they have 251 million shares outstanding. BigBear.ai develops AI and machine learning technology. They help their customers deal with complex or imperfect data. They were founded in 1988, headquartered in Columbia, Maryland. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today using the weighted average cost of capital. Free cash flow is cash flow from operations minus capital expenditures. They do have negative free cash flow each year. Revenue pretty low. It's kind of crazy it was the same in 2022, 2023, and 2024. That seems wrong. Let me bring it out another decimal point. When I brought it out another decimal point, 2022 and trailing 12 months still matched. I brought it out another one. So you can see they are different, just really close, within $200,000 of each other. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is the sales for the company, and that's pretty flat. 146 million to 155 million. Not much growth. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 3.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We got a value of the company of $2.5 billion. We divide that by 251 million shares. And we get a calculated stock price of $10. They're trading at $8.59, so they're trading at a 14% discount. It's a buy according to the model. It's pretty hard to value this stock because you really don't know which direction it could go. I'm assuming they will hit $1 billion of revenue by 2027, and they'll convert 20% of that revenue into free cash flow. If I'm on target, the stock does seem slightly undervalued, but the stock could easily 10x or easily go down 90%. You never know. If you put $10,000 into this company when they started trading, you'd have $8,800 today, a 12% loss. At one point, your $10,000 would have been $12,600. At another point, your $10,000 would have been about $1,000. You would have been down 90%. But if you picked it up down here, you could have made an 800% return. To summarize, I have them trading at a 14% discount, ranking 3 out of 10. I'm not too sure about this stock, so I probably wouldn't buy it. Short-term and long-term, 2 out of 10. Ratios, 2 out of 10. We can't look at that PE or price to free cash flow. They have negative earnings, negative free cash flow. Price to sales is a bit rich at 14. Price to book, 17. Price to book is stock price over book value per share. Financials, 2 out of 10 because their revenue is flat. When you're this small, you want to see revenue go up quite a bit, or at least up. They're not up at all. Let's look at our 10Q. Here's their income statement. Revenue for the third quarter, 42 million. That's up from 34 million. Let's see if they give a breakdown of the revenue. Here's a breakdown of the 42 million of revenue. Time and materials, 24 million. That's up from 19 million. Firm fixed price, 13 million. That's up from 10 million. Cost reimbursable, that's up slightly from 4.5 to 4.6 million. They give a breakdown of revenue by customer. We don't know what the customer is, but customer A is 11% of their revenue, customer B is 16%, customer C 12%, customer E 12%. So these 4 customers are 51% of their revenue. Half their revenue is from 4 customers. The other half is from all other customers. I don't know how many the all other is. It could be 10, it could be 1,000. Here they talk about the revenue increase. Revenue increased 7.5 million this quarter compared to last quarter. That's mainly from their acquisition of Pangiam, offset by decreased volume in certain Air Force programs. So they work with the U.S. Air Force. Let's see if they talk about the Pangiam acquisition. They passed through an $85 million goodwill impairment on that acquisition. That's not good when a company passes through a goodwill impairment. That means they're lowering the value of that company. Goodwill is a meaningless asset. It's just a plug. So when you acquire another company, your balance sheet balances. If they reduce the value, pass through an impairment, it implies revenue isn't as high as they thought it would be when they acquired the company. Here they talk about the acquisition. In February 2024, between this company And Pangiam, let's scroll down a little bit. It looks like that's when the merger went through. In order to complete the merger, they issued 61.8 million shares of common stock because you have to fund the merger, fund the acquisition, either with debt or equity. They used equity. The $62 million shares were at a price of $1.34, representing an enterprise value of 70 million. So 61.8 million times $1.34 is 70 million apparently. They also issued another 2.1 million shares valued at $1.39 each. So here's a breakdown of everything. Equity issued $208 million. And what did they receive for that $208 million? It was actually $211 million. There was a holdback amount as well. They received $14 million of cash because that company had cash on their balance sheet. They received $5.8 million of accounts receivables. The biggest was goodwill. Well, it says intangibles, probably mostly goodwill there, $39 million. When they acquired this company, they also acquired their liabilities. There was $6 million of long-term lease liabilities, accounts payable $1.1 million. So the fair value, the assets minus liabilities, is $55 million. They paid $211 million. So $211 million minus $55 million is $156 million, which is goodwill. So this $39 million is not goodwill. It could be customer relationships, patents, trademarks, or something else. Here we go on the next page. The following table summarizes the intangible assets. A lot of it was technology, $15 million, trade names, $1.6 million, and customer relationships, $22 million. Customer relationships are the customers they have. That's an intangible asset. It will lead to revenue and cash flow in the future, but the actual relationship is intangible. This company doesn't like spaces. Again, there's no space right here. It's kind of annoying. Up here, it was something similar. Right here, between the of and the 61 million, there's no space. Let's go back to the income statement. Below revenue is cost of revenue. These are all the expenses directly tied to generating the revenue, 31 million. And their gross profit, 10.8 million, up from 8.4 million. They talk about cost of revenue down here. It did go up 5 million, but it went down as a percent of revenue from 75% to 74%. The decrease in cost of revenue as a percent of total revenue was driven by a higher mix of higher margin solutions work when you compare last quarter to this quarter. A little vague, but that's what it is, I guess. SG&A, that includes marketing, 17 million, R&D, 3.8 million. So gross profit minus these two numbers gives you your operating loss of 10.5 million, which is worse than last year of 8.2 million. Let's see what they say about SG&A and R&D. SG&A increased in total dollars. It looks like it increased about 2 million, 15.5 to 17.5. That's from an increase in headcounts. They added employees, non-recurring strategic initiatives of 1.4 million, and non-recurring integration costs of 700,000. R&D went up 4.2 million. Last year, they passed through a gain of 349 million. This year, an expense of 3.8 million. Again, they don't have a space between two letters. It looks like they have some debt. The interest expense was 3.5 million. That's from their convertible notes with B of A. We can look at the liquidity and capital resources section for more info. Here's that section. Our primary source of liquidity are cash flows provided by our operations and access to existing credit facilities. Their main short-term cash requirements are to fund payroll obligations, working capital. Working capital is current assets and current liabilities. Operating lease obligations, interest payments, short-term debt, including current maturities of long-term debt. Their available cash doubled from 32 million to 66 million. Their cash balance went up not because they're profitable, because they added more of these debt lines. Sounds like a drug reference. Are you ripping those debt lines? Let's go back to the income statement. So their net loss is 12.2 million. Last year, they had a gain of 4 million. That's surprising. The reason they had a gain, because of the fair value of derivatives. That was positive 16 million. This year, it's positive 1.3 million. When it's a negative expense, it's a gain on the income statement. Because an operating loss of 8.2 million plus 15.7 million minus 3.5 million, that equals 4 million. Let's look at a company on Simply Wall Street. Its last price, $8.59, 1.7 billion market cap. It doubled in the past week, up 100%. Why did it double? It's up 360% in the past year. They secured a government contract with the Department of Defense. So the news moves stocks a lot. The contract aims to enhance the company's virtual anticipation network, VANE, for geopolitical risk analysis. AI stocks have been on a roller coaster this year, from a 1-2 punch of DeepSeek and tariff fears. Meanwhile, corporate America is pouring billions of dollars into AI capex. Meta, Amazon, and Google alone probably spend $100 billion in AI capex. Tech stocks never promise a smooth ride, and AI stocks are a case study in volatility. A trio of AI stocks, BigBear.ai, Palantir, and Cloudflare, have bucked the trend, soaring by at least double-digit percentages and leaving their peers in the dust. Of the three stocks, Big Bear advanced a whopping 27% on Friday alone, touching a 52-week high. Palantir up 38%, not to be outdone by Cloudflare, rose 17% on Friday and gained 25% for the week. BigBear.ai provides AI solutions to the defense sector and supply chain. They got a key government contract with the Department of Defense, creating FOMO around the stock. They were chosen by the DoD's Chief Digital and AI Office to advance VANE by equipping soldiers with AI capabilities. Big Bear is close to its multi-year high, has gained a reputation as a next Palantir, which also made our list. It looks like Big Bear is a SPAC because it traded at $10 for several months. Then when they announced the acquisition, the stock was cut in half to $5 in 2022, ran up to $12 in April 2022. It fell to below $1. So I'm sure if you bought it at IPO, you would be pretty unhappy. And most people would have sold and cut their losses. But this stock has killed it. Even by the end of 2024, we're still pretty low, $1.49. But just the past week or so, it's shot up. It's getting close to its IPO price. Simply Wall Street does not value this company. 4 analysts priced this stock at $5. They say it's really overvalued. Here's their revenue since 2018. It was $49 million. Then by mid-2023, it tripled to $160 million, but it's been pretty flat since then. It's $155 million currently. Their debt in 2020, $100 million. Now it's $200 million. Their equity was negative at one point, negative $67 million in 2023, but it's positive again, positive $98 million. And they have $66 million of cash, plenty to service the debt. Lots of insider selling in the past year, 10 million shares, 15 million shares. It's a really long list, mostly by AE Industrial Partners. They must have been involved in the SPAC. There was a buy of 140,000 shares at $1.49. Pamela Braden, so she's doing really well. Still more and more sells. So about 90 million shares were sold in the past year, 140,000 purchased. That's by insiders. 62% of the companies owned by the general public, 26% by VC or private equity firms, 10% by institutions, and 2% by insiders. AE Industrial Partners is the biggest shareholder. That's an aerospace private equity firm. They're located in Boca Raton, Florida. They focus their investments on highly specialized markets, including national security, aerospace, and industrial services. Their employee count went down from 620 to 480. The ticker trades on the Deutsche Börse and New York Stock Exchange. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.